This is the Board of Retirement meeting for March 15th, 2023. We'll call that to order, and the roll call, please, Ms. Zeller.
Ms. Harris? Mr. Anderson?
Here.
Ms. Cubison?
Here.
Mr. Jurdy?
Present.
Mr. Cromer?
Here.
Ms. Cavanis?
Here.
Catherine Smith and Richard Shoemaker are absent by prior arrangement, and Mr. Hawkins has resigned from the board.
So that'll be the Pledge of Allegiance. Trustee Cavanis, would you lead us, please?
The flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you. The next item is public comment for items not on the agenda. Members of the public are welcome to address the board on subjects both on and off the agenda. Do I have any members of the public that wish to address the board at this time?
I do not see any public comment at this time.
Thank you. Item number 1 will be discussion and possible action regarding consideration of an item not on the original agenda to hold a special election to fill the Board of Retirement seat following Vincent Hawkins' resignation. Executive Director Rentschler, would you like to explain any more?
Thank you, Chair Cromer. We received notice after the agenda was originally published of Mr. Hawkins' resignation from the board. We would like to start the election process. First, we need, I believe, and Jeff can correct me if I'm wrong, a motion to take this item since it wasn't on the original agenda, and then the item itself is just direction. There is a board cover memo in there. If you have any questions regarding that or the timeline, I'm happy to answer any questions.
And my understanding as well, on top of the motion, it would have to be unanimous vote from the trustees in attendance to pass that motion to then consider it and give direction. Is that correct?
Yes, I believe that's correct. And the Brown Act provides for items to be heard off the agenda if the item came to the attention after the agenda was already published and there's a need for taking immediate action. And that is the case here because the statute, when there's a vacancy, requires that the position be filled at the earliest possible time. This board already has a vacancy. We're still coming out of COVID. We only meet once a month. I believe there's absolutely sufficient justification for the board to consider this item today.
Okay, so we've met that threshold. Thank you, Mr. Burke. Is there any trustee conversation that you would like to have?
So are you looking for a motion to add this to the agenda? Okay, I'll move to add this item of filling the vacancy on the agenda.
We have a motion and a second. Is there any public comment regarding this item?
There is no public comment.
Any further trustee discussion regarding this item? Okay, Ms. Zeller, if you'll take a roll call vote, please.
Ms. Harris? Mr. Anderson?
Aye.
Ms. Cubison?
Aye.
Mr. Jurdy?
Aye.
Mr. Cromer?
Aye.
Ms. Cavanis?
Aye.
Approved.
So the motion carries. That allows us to discuss this item. Executive Director Rentschler, if you have any other further details regarding the prepared documentation.
The timeline, if we meet that, would allow us to swear the new trustee in at the June meeting at the earliest. The estimated cost for running the election is $1,500.
I believe recently we renewed that special election policy, so this is all in compliance with that policy.
Yes, back in August of last year, the board adopted a board election policy that specified certain minimum timelines to be met in the election timeline, and this timeline is compliant with that.
Thank you very much. There any trustee conversation regarding the memo prepared by Executive Director Rentschler? From my understanding of reviewing it, we don't need a vote. We just need direction given to staff on this.
That's correct.
I would support the proposed timeline as presented by staff.
Thank you. Any further discussion regarding the proposed timeline or the memorandum? Any public comment regarding that item?
There is no public comment.
Hearing no other conversation, I believe directions given to staff, and I don't believe that any other action is needed on this item. Thank you.
Thank you.
So item number 2 would be the consent agenda. All matters on the consent agenda are approved by unanimous consent unless the trustee would like to pull that an item for further discussion or action. Is there any such issue on the consent agenda? Seeing none, I will consider that all items on the consent agenda are approved by unanimous consent. As far as item number 3, that would be discussion and possible action regarding investment matters. I'll ask Financial Investment Officer Mr. Reveles to introduce our guests.
Yes, trustees, we've got 3 presenters for you today from Alliance Bernstein. They're going to talk about their responsible investment approach and give a brief update on the small cap asset class and performance of the strategy that we've got. To introduce, we've got Ann Parker Whedon from the Institutional Client Group. We've got Catherine Zayak from the Responsible Investment Strategist Group. And we've got Walt Seisky from the Equity Investment Strategist Group. So, Ann, welcome, and you can take it away.
Thank you so much, Robert, and thank you all. Good morning. As Robert said, my name is Ann Parker Whedon, and I am joining you here from Alliance Bernstein's headquarters in Nashville. I'm a vice president on our U.S. Public Institutions team and delighted to be with you here today. Thank you so much for the opportunity to present. Joining us also, we have Walt Seisky in our Dallas office. Walt is a senior vice president and senior investment strategist on our equities business and will be discussing the U.S. small cap growth portfolio that we manage for Mendocino and also provide an update on the broader market. Given the current environment that we are in, please do not hesitate to raise any questions you may have for Walt. But before I turn it to Walt, I also want to introduce our colleague, Kat Zayak. Kat is based in our San Francisco office and is a vice president and investment strategist on a responsible investment team and partners with all AB investment teams to manage our ESG strategic initiatives. We are delighted to have her here on the call with us today to walk you through our ESG training that hopefully you all have received. Before I hand it over to Kat, I wanted to provide a brief update on the firm though. AB recently announced our 4th quarter earnings, and despite challenging markets for the industry, we did fare well relative to our peers. We experienced a small decline in AUM, but strong results in our institutional business with active net inflows, our 4th consecutive year of organic growth, and a strong pipeline looking ahead to this year. So in terms of the materials, I did want to, so we're able to screen share to make sure everyone can see it. So here on page 2, you'll note that AB is a global asset management firm with almost $650 billion in assets across fixed income, equities, multi-asset, and alternatives. We have more than 50 years of experience across 26 countries and 51 cities. But that's not really what differentiates us. It's our people and our culture shown on the next page. People are our most valuable asset. And as you'll see across here, you have 3 different employees across 3 different time zones to bring you this presentation today. A diverse and inclusive culture is a priority of our CEO, and he is committed to increase the diversity of our board. And we're currently almost 50% diverse members of the board, including an independent female chair. We're also committed to increasing the diversity of our staff and have hired several new positions to recruit, train, and advance diverse talent. We take DE&I very seriously as our CEO has made us all accountable as part of everyone's compensation. Year-end compensation is tied to how we execute on these DE&I goals. Additionally, on this page, you will note AB has maintained a long firm-wide commitment to responsible investing, and Kat is about to get into that, but I did want to draw your attention to 2 points here. First is that AB became a signatory to the UN principles in 2011. And additionally, we have dedicated substantial resources to this effort, including building an in-house team of over 20 members, of which Kat is part of, and established a industry-leading partnership with Columbia University's Earth Institute to study the impact of climate change. And so with that, I'll pause here for any questions on the firm, but if not, I'll hand it over to Kat to get into our training. All right, with that, Kat, we can move to page 4.
Great. Thanks so much, Ann Parker. And hello, board members. As Ann Parker explained, I'm on AB's Responsible Investing team. Although I work New York hours, I work from the Bay Area, so I look forward to coming up and visiting you in Mendocino next time we meet. In terms of AB's overall approach to responsibility, we take a 3-pronged approach. So first, we believe that in order to be a responsible investor, we have to be committed to being a responsible firm. This includes a lot of the initiatives that Ann Parker had explained on the previous slide. Secondly, we believe that ESG integration and engagement are fundamental to our active research and investment processes. So we really think about ESG considerations through each applicable stage of the investment decision-making process. And then finally, for clients who are interested, we can leverage our unique perspective as a responsible investor to offer portfolios with purpose, which is our ESG dedicated funds that, of course, still prioritize risk and return, but also have specific ESG related outcomes in mind. This might be a lower carbon footprint than the benchmark, or investments in companies that are improving along ESG guidelines. So responsible investing can be structured in many different ways at different asset management firms, but at AB, we take an investor-led approach. So while we do have a dedicated responsibility team that oversees both our corporate responsibility practices as well as our responsible investing practices, we partner extremely closely with our investment teams to integrate ESG. So the responsible investing team, we're subject matter experts in all things ESG. We also provide generalist resources in strategy, ESG analysis, and ESG reporting. And in order to support our investment teams, we provide many different ESG training resources, as well as internal and third-party tools and training. We also have a number of strategic partnerships, including our one with Columbia University's Columbia Climate School, which I'll go into more detail on in a few slides. Then, in terms of partnering with our investment teams really bring their sector-specific expertise to the table. They are experts in the issuers in which they invest. They know their investment process inside and out. And so when we work with them to engage with issuers on ESG topics, we can really dive deep and analyze these challenges and talk with issuers about making improvements on ESG key issues, and then factoring that into our investment decision-making process. This will look a little bit different for each investment team. Sometimes it's more of a qualitative assessment and impact on an investment thesis. We also have teams who will incorporate material ESG factors into things like cash flow discount rates and other financial modeling. So investment teams take different approaches, but they always partner very closely with our centralized responsibility team to think about ESG issues, especially material ESG issues, in a very critical way. Also, I do just want to note that while the responsibility team and investment teams are at the heart of our responsible investing process, we're overseen by a much broader governance structure. So we also have a responsibility steering committee, which includes senior representatives from different business units across AB who help advise on the strategic direction of responsible investing at AB. And then ultimately, we do report up into our own board of directors, who opines on the firm-wide approach and strategic decisions such as our commitment to the UN principles for responsible investment, or things like our partnership with Columbia University. So here's a quick look at AB's responsibility team. So we're overseen by Erin Bigley, who's our Chief Responsibility Officer. She's been with AB for over 2 decades and has a wealth of experience across the business. She oversees our team, who comprises people focused on corporate responsibility, ESG strategy like myself, or the E, S, and G pillars. So we do have a director of environmental research and engagement, a director of social research and engagement, and a director of corporate governance. These leaders on our team are supported by analysts and associates. And we also partner with folks across other teams at AB. So some of our investment teams will have dedicated ESG specialists that sit on those investment teams. And we also have specialists within our business development unit who help advise on ESG related products and other client questions and needs regarding ESG. Before I move on to our approach to ESG investing, any questions on AB's responsibility governance structure or our investment teams or responsibility team?
I just have one question. Could you just give us the ticker number for the mutual fund that we're investing with you?
Yes, Walt or Ann Parker, do you have that number?
Yeah, well, I think, are you able to provide that?
Yeah, so let me see. I think I have that handy. Bear with me. But I had that earlier. Just a moment, sorry. Usually we provided it on one venue. I might have it here. It is QU, so quality underwriting, Apple, Y as in yellow, X, so QUAYX.
All right, thanks.
Sure.
Great. Any other questions? Okay, if not, we can move on to the next slide. So why integrate ESG? Now, we do acknowledge that in recent months, there's been some controversy around ESG investing, but ultimately, at the end of the day, AB believes that considering material ESG factors can sometimes influence financial risks and investment performance. So we begin our process with deep fundamental research and engagement. This is at the heart of AB's investment practices. This is deeply ingrained in AB's history as an asset manager. And so this has come natural to us to research these ESG issues and determine, are they material? Could they have a material impact on the financial performance of an issuer? So when we embed ESG research into engagement and integration into our investment process, we believe this can improve our risk assessment and help us identify opportunities on the upside as well. And ultimately, at the end of the day, our primary focus is making better decisions and providing better outcomes on behalf of our clients. So this is really how we think about why we would want to integrate ESG throughout our investment processes. What does ESG integration actually look like? How do you define ESG integration? So at AB, we think about ESG integration as thinking about ESG considerations at each applicable step of the investment process. What this looks like, let's start with idea generation on the top right-hand side here. So initially, when investment teams are thinking about opportunities and risks and potential investments, they're thinking about material ESG factors that will differ by industry, differ by sector, and that helps generate some initial ideas. We do have a proprietary materiality matrix by sector that helps our analysts understand what are the more material risks when it comes to ESG in certain sectors, and where can we dig in deeper on an issuer by issuer basis. So after we've generated an idea, our analysts typically follow up with research and analysis. So we do a mix of proprietary research, but also leverage things like third-party tools and data sets to help understand these ESG risk characteristics of issuers. After that research and initial analysis, we oftentimes engage directly with issuers. So this means meeting with private and public companies, municipalities, sovereigns, et cetera, to talk about ESG issues. Sometimes we simply engage for insight where we're asking about ESG issues that might be somewhat unclear in public disclosures or something that's come up in the news recently. But sometimes we engage for action where we work with an issuer to help them better understand the issue they're facing and ask them to make material improvements on this ESG issue so that they can actually decrease their risk exposure in this regard.
Catherine, I believe we
Next.
do have a question if we can interrupt, and I apologize.
Oh, yes, please go ahead.
Trustee Anderson.
Catherine, I appreciate your the information, and as you mentioned earlier, the kind of the some of the debate that's going on, and as I've been trying as a trustee to do my research, I've been watching a lot of the strings on ESG, and it seems to be a recurring theme that one, very difficult, to determine what are appropriate factors, how you essentially quantify or evaluate those factors is a significant problem. And then even access to that information, getting beyond, say, an independent scorecard group or oversight group to actually being able to access data from the industries or the companies that they're supposed to be scoring. And it seems to be more frustration at the lack of how ESG is working than there is optimism that we're going to get there. Am I wrong on that?
No, thank you for summarizing that. I think you've summarized the debate and some of the frustration in the market very, very well. So what I would say from AB's perspective is I had mentioned that we use these third-party tools and data sets, things like MSCI, ESG ratings. We'll take a look at that analysis from third-party data providers. But really what's at the heart of our practice is our own fundamental research and engagement. And so oftentimes those third-party data sets and providers are a good starting point, but it really requires deep fundamental analysis and your own proprietary research to dig into these issues and cover the true details from companies. So part of the way we actually do that is through engagement, where we meet one-on-one with companies and ask them about the ESG issues they're facing. Oftentimes, our engagement is not only asking about the issues at hand, but encouraging companies to improve their disclosures. Disclosures tend to be a little bit stronger in, say, for example, US-based companies where there's tons of regulation around disclosing ESG-related metrics and other metrics. But then sometimes when we look at companies, say, in emerging markets where these practices are still evolving, disclosures can be very rudimentary. So part of our efforts as a responsible investing team at AB is, yes, engaging with companies one-on-one to suss out the details, but also working with other entities to help encourage improved disclosure across sectors, across companies, to elevate everyone's understanding of these issues and these risks that companies are facing. Does that help answer your question?
That does. And then just a follow-up too, just kind of trying to look at, and it's very current things. I mean, you could make a pretty long list, but
yes.
For example, this week where strategic oil reserves are opened up for development, but the larger policy issue is homeland security and issues of supply chain. If there are further kind of global events, we've got conflict in Ukraine, kind of the growth and the militarization of China. And so seeing more and more things for potential defense spending. I was watching encouragement of a new class of individuals coming forward for the advanced weapons of warfare. I don't know how to better describe it. New submarine fleets and those types of things. Typically, those wouldn't score really high on an ESG just because of the industry. So you're dealing with warfare, you're dealing with oil production and so forth. But from a public policy standpoint, it might be the correct thing to do. How does AllianceBernstein evaluate something like that?
Yes, there's tons of nuance, right, in those issues. And so when you think about ESG scoring, if you roll everything up into one ESG score, it removes that nuance, or at least obscures it. So we think it's really important to dive into E, S, and G issues separately and really understand, okay, from an environmental perspective, this company might be doing wonderful things, but from a social perspective, maybe they really, really lack on D&I practices or have poor labor management practices, something of that nature. I think when it comes to more of those macroeconomic or geopolitical issues, we really try to take it on an issue by issue basis and understand where are the key risks here, where are the potential opportunities, and ultimately if there's a risk that we think will have a material financial impact on a company and it doesn't make sense to be invested in that company, we will consider either engaging with the company to make sure that they're mitigating those risks, or and sometimes considering things like divestment or other escalation strategies. So we do have a few different approaches in our back pocket in order to tackle these concerns company by company.
Thank you.
Great. So I think we were talking about investment decisions and actually incorporating analysts' assessment of ESG risks at a particular company into their investment decisions. So this might be, okay, we have a more favorable perspective on this company now that we've assessed the ESG risks and opportunities, or maybe we have a less favorable view of this company. Some analysts will even incorporate it into their financial modeling if they have the data to quantify ESG issues. So we see our investment teams incorporate ESG into investment decisions. And then the final step in ESG integration, which actually touches upon some of these policy issues and geopolitical issues, is long-term stewardship. So this is the idea that after we've invested, the story is not over. So not only do we continue to engage with the company on ESG risks and opportunities facing them, but we also partner with industry organizations and advocate for policies and other advancements in the ESG and responsible investing space to make sure that these longer term broad trends are being addressed in a way that's most beneficial for clients. Great, so I did want to dive a little bit more into engagement. So on the previous slide, I had mentioned that we engage for insight and engage for action. So engaging for insight, that's really when we're just trying to learn more about an ESG issue. As I mentioned, we do start sometimes with third-party ratings, but unlike, say, a passive manager who would just take those ESG ratings at face value and invest accordingly, we dive in with our own proprietary research to understand, okay, this has a good, maybe another third-party data provider has assessed a company as having strong ESG credentials, but when you dive into the details, perhaps there's really, really strong environmental practices or social practices or some other nuance that isn't being captured in top-line scores. We also will engage for action, where we actually are encouraging issuers to make improvements in their business activities. And this is always focused on shareholder value, so reducing risk or improving opportunity options. We have a few internal tools that we use to help track our ESG research and engagement. This allows us to collaborate across our investment teams. So one of those tools is called eSight, which is our ESG research and collaboration platform. This is where analysts can document engagements, including what they discussed with the company, what the key takeaways were. We also can use this tool to help track engagements and report to clients if they're interested about that information. In terms of what firm-wide engagement looks like at AB, we engage with we conducted almost 2,000 ESG engagements in 2022 with a little over 1,400 unique issuers. So companies, sovereigns, municipalities, et cetera. Our split between talking about environmental, social, or governance issues was pretty even. And you can see in these lists what some of the more popular topics were. For example, under the environmental umbrella, we talked to a lot of companies about carbon emissions. We talk about opportunities in renewable energy, clean tech, green buildings, et cetera. On social, D&I continues to be a very popular topic at companies. And then governance, will talk to companies about pay practices, board diversity, board independence, things of that nature. I do have a quick slide here on our approach to shareholder proposal assessment. So we have a firm-wide, publicly available proxy voting and governance policy that you can access on our website. And our philosophy when it comes to shareholder proposal assessment is we do not automatically support every shareholder proposal that mentions ESG or climate-related topics. We will really evaluate these proposals one by one to make sure that they're really genuinely improving ESG outcomes for companies. So our responsible investing team also spearheads our proxy voting processes. And we view this as another way for us to enact those stewardship practices that I mentioned earlier. And then finally, I did want to make sure that we had a chance to talk about our partnership with the Columbia Climate School. So I mentioned this up top. Since about 2017, we've been talking to climate scientists at Columbia University about material, environmental, and climate-related risks and opportunities that could be facing companies. We acknowledge that while we are experts in investing and experts in the companies in which we invest, we don't have the climate science expertise that really we need to better assess these issues for financial analysis. So in 2019, we formalized a partnership with Columbia Climate School and rolled out investor training to more than 250 AB investors and board members. So for a week, investors partnered with Columbia climate scientists to understand the latest climate science and how this could impact investment outcomes. The curriculum was so well received that in 2021, we opened it up to some of our clients as the first Climate Change and Investment Academy, where we had multiple modules going through things like the impact of climate change on investment portfolios, Climate Change 101, and a few other modules. And in fact, that we can make that training available to you all if you're interested. So please just reach out to us with more details if you'd like to access that training. We can open it up to folks for an 8-week period, and you have that time to look at the 6 modules and all the other recorded sessions. So if you're interested, please let any of us know. And going forward, we continue to partner with the Columbia Climate School. So we've conducted different research projects with them. We work one-on-one with the scientists to understand how climate science is evolving and what kind of policy, but also implications this could have for companies that we're invested in. And we're looking to develop future climate and investment academies for clients and other interested stakeholders. And with that, I think that was my final slide. So perhaps I can take any other questions, but then I'll pass it over to Walt and Ann Parker.
Thank you, Kat. Robert, I just wanted to check on time briefly to make sure we're still on track.
We are.
Oh,
Yeah.
okay.
But we got about an hour, so we're about
Okay.
halfway through.
Okay, perfect. All right, just want to make sure we were good for your end as well. And also to all of the board members, we've provided the climate curriculum information to Robert as well. So if you want to reach out to him, he can pass on your information to us, and we're happy to coordinate. And so we'll pause here for questions, but if not, we'll hand it over to Walt. All right, Walt, you want to? I think we're now on page 16.
That's correct. That's correct. Thank you so much, Ann Parker. And thank you all for allowing us to join you at your meeting today. We appreciate the opportunity and we appreciate the relationship. So the place I would like to begin is performance and the portfolio that you have invested with us, which is our small cap growth service. And on the top of this page, on the top table that you can see, we're showing end period performance for various timeframes So the longer term timeframes, as you look a little further to the right, a 1, 3, 5, 10, 7-year, as well as since inception, which the inception date of the Ural's engagement with us on the service was September 1st, 2015. And we also showed a few more recent time frames. If you look to the left-hand side, most notably the January through February performance through this year, 2023, fourth quarter of last year, and then 1 year. I'll start by acknowledging that last year was a very challenging year for not only the equity markets, but the asset class, that being small cap growth, as well as our returns relative to that of the benchmark. And you can see that in the third column in that top table, where we had underperformed the benchmark by just roughly 12.5% for the calendar year. As we discussed with Robert and to share with you all too, in periods where we have a severe style rotation that is out of growth into value, as we saw last year, and particularly in the front end of 2022, that will serve as a headwind to our performance, given our style purity in the small cap growth space. But as you can see from the longer time periods that we show in the top table, we've been able to drive a substantial premium to the benchmark, and happy to report that year to date, granted it's just a couple months in, we do have a lot of turbulence in the markets, but through February, we were ahead by just over 2% relative to the benchmark, as we've seen a bit of a shift out of value into growth equities, given some of the economic concerns that we're seeing, considering Fed tightening, considering that's what's going on in the banking complex. Investor fears have centered more on economic downturn. In that particular case, the companies that we buy, which are those that consistently surprise on the earnings front in the revenue growth, tends to serve us well relative to other strategies in the market, because these companies, if we're able to identify them as we've been able to do so successfully on a consistent basis, they get accorded a scarcity premium. That is, not every business is going to grow well when the economy slows. Those are the types of businesses we're seeking, are those that can grow and have that consistency of growth. But in a year where the Fed was tightening, we had a significant style shift. As I mentioned, that tends to be a headwind to our style. Below that, we also show the full fiscal year performance for Mendocino. Again, your portfolio's return relative to that of the Russell 2000 growth, which is our benchmark, and the relative performance for each respective full fiscal year. Let me just check in before I get into attribution, the landscape, what we see ahead. Any questions on the performance? And again, some of this could be answered as we get into contribution to returns for the quarter, et cetera.
Yeah, so I'm looking at the Morningstar website and their performance analysis of different funds, including this fund, and it's showing that in the last 3 years, this had a standard deviation of 27%, or 27, and the S&P 500, which I actually think is really our benchmark, because we have about 62% of our equities in the U.S. In the S&P 500, and really what we have is 5 actively managed funds that are alternates to what I consider our benchmark, the S&P 500. And so the benchmark for me, the S&P 500, had a standard deviation in the last 3 years of 21%. So anything and above that is, in my mind, worse than the S&P 500. And it showed above average returns during the 3 years for S&P 500, and for this fund, it showed below average. So I guess what I'm looking at is trying to develop a portfolio at MSERA that, if we're going to have something other than the S&P 500, it needs to outperform in 2 key benchmarks. One is it needs to have a lower deviation, standard deviation, less volatility, and lower drawdowns in the bad markets, and higher upside returns in the up market. So when I look at this fund, whether it's 3 years, 10 years, or longer, it seems to be underperforming the S&P 500, and it seems to have more volatility. So I know I probably voted to add this fund, but I'm just, now that I'm able to look at Portfolio Visualizer, which goes back quite a few years on this fund, and what looks like a companion fund. You said our ticker is is QUAYX, but QUASX goes back a few extra years. And when I look at the 10 and 15-year performance, it looks like it's the same. So it makes me think that these are essentially the same funds or something very close to each other. It's just that the QASX goes a little bit farther back in time. But I guess my concern is the standard deviation volatility, because the more volatile our mutual funds are, the more money that we're looking at putting into bonds, which are not going to perform as well as equities over time. So we're hurting the performance of our fund as we put more and more money into bonds to compensate for the volatility that's in our equities. So from my perspective, we want to have equities that can both have lower volatility, lower drawdowns in down markets, so that we can not put more money into bonds and to keep more money into equities where we can have a long-term better yield for our investment return. So do you understand what I'm trying to get at?
I do, and a couple things at a high level. If we look over, especially since 2008, for the most part, large cap stocks, especially the S&P, has dominated that of smaller cap stocks. And over longer time periods, small caps have actually outperformed large cap stocks. But with that comes that higher degree of volatility within the asset class. So that's going to be characteristic of small cap companies. We will stay within the mandate in which we were hired, which is to manage against the Russell 2000 Growth Index. And with that, as I noted, is going to give a higher degree of volatility. I think something that might be instructive in terms of how we've done relative to our benchmark, to put a little finer point on this. And Parker, maybe if we could go to, I believe it's slide 54 in the deck, in the appendix. Okay. So what this is showing is a couple of things, and hopefully this gets a little more color. Again, staying within our peer group, within our benchmark and our mandate, which again is the Russell 2000 Growth. What you see on the left-hand side is the percent of quarters that our portfolio has outperformed the Russell 2000 Growth, and this goes back to the team's inception, which is February 28th of 1999. And then if we look at the up and down capture, again, since team inception, up capture ratio of 106, where the down market capture ratio in tougher market periods in time has been just under 94%. So, clearly if you stack rank the volatility and more recent performance, especially coming out of the credit crisis, where S&P has dominated for the most part, and it's been a tough comparison within that window. But within our peer group, our consistency of outperformance, as well as the up-down capture, we stack up pretty well relative to our peers in different market environments. So hopefully that provides a little more color.
So I understand what you're saying, and I think it's absolutely generally true that the smaller cap funds have more volatility, generally speaking, than the S&P 500. But there are some funds out there that have been actively managed, as this one's actively managed, that have not had the same volatility as the average of small cap and large and medium cap funds. And so we have another actively managed fund within our portfolio, the Fidelity Low Price Stock. It's actively managed like this fund. It's small and mid cap funds, and it's had significantly less volatility than this fund. It's had a standard deviation since 1997 of 15.6 versus 22.6. And it's had an average return of 10.96 during that time period versus 7.4 for this fund. So one of my point is that, I'm trying to, I really appreciate the ESG, background that may be embedded in this fund. But in terms of performance, there are other small cap, mid cap, actively managed funds with less standard deviation and with higher performance than this one seems to have. And so I personally feel like this is hurting our fund overall to have anything in the portfolio that's not beating the S&P 500, at least on standard deviation and drawdowns. But collectively, I think our portfolio that is not in the S&P 500 collectively needs to outperform it. Otherwise, we should just put the money in the S&P 500. So I'm looking for a strong, compelling argument to keep this in the fund.
Right, right. So I'll just address it through the lens in terms of our mandates and how we've managed and how we've ranked relative to our peers. I could provide a little more color on that as well. Within our peer group, over time, the last year was a challenging time frame for us, as I said, when we have style rotations of that order of magnitude. We've been able to recover pretty smartly, but relative to our small cap growth peer group, if I look out longer term over a 10 and 15-year period, we've been consistently top quartile, and over the 15-year time frame, we've been in the 14th percentile in our peer group. Some of the volatility that comes with our portfolio, I'd have to take a closer look at some of the your other manager, and maybe we could glean a little more information. Happy to work with Robert on that. But our style purity is one of the hallmarks of our strategy, which over time has done quite well. I would also mention, and I think it goes to the consistency of the performance in terms of what we're looking for. And maybe Ann Parker, as I'm kind of going ahead to address the question, what if we could go to, let's jump to slide number 22, I believe. So this is what this is showing is what we focus on, which are companies that give us a greater than average hit rate in terms of those companies that are giving us earnings estimates on the earnings that are higher than the overall benchmark, as well as companies that revise their earnings or their profitability higher over time. And that's what we're showing on the right-hand side. And you can see that this is a look back, going back as far as 2005, where we've been consistent in that category of outperforming the benchmark, or identifying those companies that lead to that outperformance by having either their estimates on the revenues or earnings going higher. I would say the other thing too that I could point to in terms of the long-term efficacy would be maybe slide 41. And I'll stop here because I want to keep the time and make sure we have questions. What this is showing, again, since the team's inception, we look at our stocks both from a fundamental and a quantitative lens. 60% of what goes into our stock analysis is fundamental, what a lot of the things you would expect us to do, where we think the earnings and revenues, the competitive position of the company. Our quantitative rankings are things such as earnings revision and momentum. And the stocks that are highest ranked, which you see here, what's our ones or twos, is just showing the performance of those over time. And you can see that they've been the consistency and the persistency of that in terms of the companies that we buy. Any new stock position that comes in a portfolio have to be the rank of 1 or 2. And you can see that performance over time, and again, this goes back to the team's inception, has been quite strong. Now, yes, our volatility may be higher than that other portfolio that you mentioned. I'd be interested to take a look in terms of the types of companies they're buying, what style quadrant they reside in, et cetera. That could be enlightening, and maybe we can provide more information for the committee to see how the two compare and why they may be a bit different.
Okay, well, before we move on, I know Financial Investment Officer Mr. Revlis would like to comment.
Yeah, so I do
Sure.
want to jump in here and kind of reiterate what you're saying, Dan, and that is factually correct. The smaller, there's something to be said for the market capitalization of the strategy, and also whether or not the strategy is going to be a value tilt or a growth tilt. This particular strategy is a small cap growth strategy. It's going to be much more volatile. It's going to have smaller companies than the Fidelity account that you're referencing, which is a mid-cap value strategy. So they're quite different. And so that's something that, the full board should consider when you're thinking about these types of things. Trying to compare Fidelity with AB is a little bit like comparing apples and oranges.
Well, but when we hear the phrase growth, we think that it's going to outperform in the long run, and actually it underperforms in the long run in terms of total return, and it gives us extra volatility, so it's a loser on two fronts.
This particular strategy's goal is a 4% net outperformance versus the Russell 2000 Growth Index. If you look back at our last quarterly report, you could even look at our monthly report. The monthly report doesn't go back 15 years, it only goes back 10 years. That time period also includes, significant drawdowns from COVID. So the total returns they're not necessarily on this particular time period beating that 4% net growth, but they are outperforming the benchmark. If you look at the December report, 10-year return for the strategy, 11.27% versus the Russell Growth Index of 9.2%. And if you look at the February investment report, 10-year return of 11.75 versus 9.31. So you can see those are similar return numbers.
Well, Portfolio Visualizer has records for this fund that go back to 1997, January 97, and to date. And during that time period, the S&P 500, our Vanguard fund, index fund, earned 8.6. This earned 7.4, so it's a full more than 120 basis points below the benchmark, which is I'm going to call the S&P 500 our benchmark. It's 120 basis points lower. And the Fidelity low price stock, which is mid and small cap value, not growth, although it's only value and not growth, it earned 10.96. So it outperformed the S&P 500, outperformed this fund by over 300 basis points. And the Fidelity had standard deviation of 15.6, S&P 500 15.7. This one had standard deviation of 22.6. So huge standard deviation underperformance versus our benchmark, the S&P 500. Huge standard deviation underperformance versus the Fidelity fund, and it didn't yield the results that we were hoping to get. And so my point is, no offense to this fund, this is a strategy that somebody out there wants. I'm saying it's not a strategy I want in our portfolio.
Dan, if I could respond to your comments, we will be doing further portfolio review where we go into more detail about how much should be allocated to the large cap S&P 500 and small caps, et cetera. And that's really a discussion that we'll have with Callan as far as the different segments of the domestic equity portfolio. One could argue that comparing what you say is our benchmark of the S&P 500 is in a way similar to what Robert said, comparing apples and oranges, because they're in a very different type of investment. And the decision the board has to make is whether or not that decision to invest in smaller companies, which in many instances will outperform a larger broad-based market like the S&P 500. But again, it's been a very unusual sort of decade here where small cap has not seen some of the glory years that it has in the past. And that's a discussion we'll be having with with Callan over the coming months about what is it that the board wants as far as the different components making up their equity allocation.
Thank you, Executive Director. Are there any other comments from trustees at this point? I know we're coming up on the timeline for this educational piece.
If it does go longer because of questions, nothing wrong with that.
Absolutely, I agree. And I do appreciate Trustee Jurdy's comments, because at the end of the day, our primary responsibility here is fiduciary responsibility. And I feel like in my time on the board, and it's significantly shorter than Trustee Jurdy's, we've been caught in the past a little bit. And I understand this was a 2015 investment, but we should question these things, because if we keep moving in the same direction without looking at alternatives, or even in our rearview mirror, as Trustee Jurdy is doing right now, well, we're bound to repeat the same mistakes or not consider alternative investment strategies. And I can tell you, in my time on this board, the volatility has bothered me every single time I see that statistics and that graphic that Callan puts in our report. And it's not just this fund, and I don't want them to feel beat up because they're here for an educational piece, but we should consider that as a board, because that is our responsibility. So I do appreciate your comments and your research. Walt, if you would like to continue, thank you.
Yeah, sure. No, I think maybe in the interest of time, I'd like to finish up with a few things to take into consideration that I think are germane and tangential in terms of some of the questions and some of the items we've been talking about. Maybe Ann Parker, if we could go to slide 23. I've contained other information in terms of attribution, contribution for the backdrop, et cetera, in terms of the portfolio and the broader markets. But focusing in on the Russell 2000 growth, just the small cap growth asset class in and of itself. If you look on the left-hand side, this was last year was an extraordinary period in that if we go back in time for this asset class, this was the third worst year, that is 2022 for calendar year performance for the Russell 2000 growth, just at the index level. If you look on the right-hand side, I think this is interesting, and maybe I'd ask the committee maybe to take this into consideration in terms of recent past versus maybe what we see ahead. If you look on the right-hand side table, we show the years and we rank them by worst calendar year performance, 1 year performance. That's the first column. Excuse me, the second column, we show the year on the first. If you look in the middle column, the subsequent return over a 12-month period of time, you see the numbers, and they are substantial. If you look 3 years out, let's say you have an intermediate term time horizon, market cycle, the next 3 years, we show the returns in years where the drawdowns have been so extreme. Now, on the second to last row, we show the average drawdown 19.2%. The following 12-month return on average, up about 22, following 3 months, 11.9. And then we show the hit rate, if you will, or percent positive. It's 78% of the time over subsequent 12 months, you've had positive rates of return, and you've had positive rates of return over the next 3 years, 88% of the time. That's meaningful, and that's something that I think is we look ahead, that it's set ourselves up for what we think is a good recovery opportunity. And for our fund specifically, the next slide, please, Ann Parker, what we're showing in terms of would we have years like we had last year, if our model underperforms, this is what we're showing on the left. And again, the team that's been managing this portfolio has been doing it since 1999. Here we're showing periods of underperformance. And on average, you can see it's a negative 3.6%. Last year, obviously, was a very challenging year. But in what we're showing in terms of subsequent returns in these periods over time, what the annualized return or the outperformance, that's what you're seeing on the right-hand side. And on average, we've outperformed by 10.6% in periods of time where we've had this degree of underperformance. At the portfolio level further, I would say, Ann Parker, maybe if we skip, well, first just at the asset class level, 26, that slide. So this is just how extraordinary the sell-off in small cap versus the S&P as an example, which I know we've been talking about. This is at an extreme level. This blue line is showing you the percentage of small caps in aggregate, the percentage of the US stock market. What's their market cap relative to that of the overall US stock market? And you could see that it was hitting historic lows. We saw this go just right under 4% during the height of the pandemic. We hit it again last year. And so we think we're setting ourselves up for a substantial recovery, because that is a massive dislocation. And we would deem in our portfolio a period of significant value opportunity, which is on the last slide that I'd like to speak to, which is the next slide, please. So this is just effectively showing, again, that since the team's inception, the price to forward earnings of our portfolio versus that of our benchmark. And you can see that it is troughing. And that blue line is at the very bottom end of that channel. And in periods when that's happened before, the subsequent recovery has been meaningful and substantial. And we think that we're in that period at this stage right now, just given the fact that small caps have been out of favor. You combine that too with last year's underperformance, which again was a very challenging year for us, no question about it. But our subsequent recoveries, when we've been in periods of time like this, when you see this overtake value versus growth, historically has been quite strong. And we appreciate the relationship and the commitment we've had with you all. I would just hope that we can retain that, because I think that there's a lot of upside that we could deliver for the plan over time, just given the extreme nature of the sell-off that we saw last year, not only in the asset class, but within our portfolio. So let me stop there, Robert. Again, I want to be sensitive to time. We're just a little bit over.
If I can, at this point, I do appreciate the graphic on slide 27, but the low point in 2022 looks lower than anything on that chart for the last 20 plus years. And the only analogy I can raise in my mind as a sports fan is that I'm a self-loathing Oakland Athletics fan and Chicago Bears fan. And it's one of those things that I tell myself every year, it can't get any worse. We only won one game where we were last in the division. And that seems to be a self-serving statement on some of these slides, that it's going to get better because it has never been worse. And I guess, ask for your response to that analogy.
Now, fair question. I would go back to some of the information I was sharing with the committee earlier, and that over time, since this team's inception, through multiple market cycles, we've been able to deliver a meaningful premium to the benchmark and have ranked very high to our peers. There have been periods like last year that have been a very, very challenging and hard year for us and our clients. We make no excuses for that. But what we've seen over time through full market cycles is that we've been able to deliver very strong results relative to our peers and relative to our benchmark into the mandate in which we're managing. All I wanted to illustrate here is to abandon a strategy that has done as well as it has, going back to 1999 at this stage in the game. I don't think that would be a very good exit point, just given the extreme sell-off, given what we see going ahead in that if the economy is slowing. And if we could continue to identify successful companies that are going to deliver on the top and the bottom line and surprise that of the market, which we've been doing for quite a while now. And I think the market has kind of signaled this, because again, we showed the performance through February. 2 months doesn't make a trend, but the fact that we were ahead to that degree and investors are shifting their preference away from value into growth, that to us gives us encouragement.
Thank you, Walt. I appreciate the response and comparison.
Sure.
Any other trustees at this moment have comments or questions? Not seeing any. Are there other slides that you or your partners would like to cover at this time, Walt?
No, I don't believe so. That's it. And Parker, is there anything that you would add?
I would just say thank you all for your time and for the opportunity to present. Robert, especially, thank you for your partnership.
Absolutely, and I do appreciate the presentation. I know we've talked about ESG quite frequently in the last year, and I know we still will continue to do so. So I do appreciate the effort and the work put into this presentation. That would potentially move us on to item B, 3B, which would be the monthly investment performance report. Mr. Revelis, would you like to present any details or information on that?
No, you have the report in front of you. You can see some some rebalancing that was done, moving $24 million out of equities into the fixed income. That's probably the biggest takeaway there, which I know we're going to discuss in the next item as well. So.
We will. With that being said, unless I see any comments, is there any public comment regarding any of the items under item number 3?
There is no public comment.
Thank you. I would like to extend our gratitude and thanks to Alliance Bernstein for the presentation and your time today, and we look forward to talking to you in the future.
Thank you.
Thank you.
Thank you all so much.
Take care. That would take us to item number 4, discussion and possible action regarding a request for a motion to reconsider the investment asset allocation. And at this time, I would like to turn it over to Trustee Jurdy, since he drafted the memo, if he'd like to present any other information on top of what he already summarized in that memorandum.
So I'm sure everybody on the board read the memo. Basically, as I was just discussing, as we look at our portfolio, the core of our domestic portfolio is our S&P 500 index. And so it's really the benchmark, as far as I can tell, for what we should measure other funds. And so it, interestingly, there's so many more charts I could have given you guys for Portfolio Visualizer, but just to compare the 4 funds that we have except for the Fidelity Fund, so we have the 5 actively managed funds in addition to the index. If you look at the 4 other funds other than the Fidelity, going back to 1994, which is the data I have, they performed about, let's see, 9.4% collectively. The S&P 500, 9.7. So as a group, they underperformed the S&P 500, yet they introduced an extra 2% of standard deviation, went from 15.2 to 17.38. Again, taking out the Fidelity Fund, which seems to be a winner of the 5. And they had a maximum drawdown of about the same of the S&P 500. Worst year, a little worse. So in other words, they didn't recover as fast. And their best year was a little better in their very best year. But again, overall return, so in other words, an example, if you had $10,000 S&P 500 in 1997, you'd have almost $150,000 at the beginning of 2023. You'd have $137,000 in these 4 funds because of the lower return overall, but more deviation. And so the basic point I'm trying to make is we can manage by just picking different mutual funds. We can get less volatility in the portfolio, the same reduction in volatility that we were hoping to get by pulling 8% of our equities, domestic equities, and putting them into bonds. At the meeting, it was referred to, well, it's only a shifting of 4% of our total portfolio, only 3% of our domestic. But actually, that's of our total portfolio. It's actually about 8% of our equities. That's a big chunk of our equities that the board is being asked to move over to bonds. Bonds have a purpose, but we're still in a bear bond market. They're barely, if even, exceeding inflation at this point. I mean, we're hoping they hang on to equal inflation, but they're not yielding returns beyond inflation. Equities do overtake inflation over time. So it's actually, equities are earning us money. Bonds, their purpose really is to help us with the volatility. But my point is, when you look at it, there are mutual funds. We have one that's not dropping down more than the S&P 500, the Fidelity Fund, but it's outperforming the S&P 500 over time. And I provide examples of 2 other equity funds by Vanguard, actively managed by Wellington for Vanguard, that have lower drawdowns consistently than the S&P 500. So they're providing us that buffer that bonds can provide us. They don't, and yet they outperform over time, not every single year, but over time they outperform the S&P 500. So I'm not proposing this so much that, oh, let's shoot for the moon and think that, oh, maybe we're going to get 7.5% long-term results. Although I think that's actually relatively possible from this portfolio mix versus 6.9. But I mean, that's really kind of the magnitude of the difference. But what we do achieve is the same reduction in volatility that we were hoping to get by moving money out of bonds or out of stocks and into bonds. And I think Callan would agree that we're going to get a much higher probability of getting that benchmark, keeping it at 7. And I think we're going to go from maybe a 55% probability that Callan has given us in the past of meeting 7, Now, they didn't tell us 55%, but I'm betting they stuck with their 55% probability when they said they were going to get 6.9 with this shift. We can keep that 7%, but maybe go from 55% to something more than 55% probability of hitting 7%, which I think is ultimately what we want, right? We want to have a higher probability of hitting our benchmark and keeping our money in equities, less volatile equities that have a history of outperforming S&P 500 is our best shot at hitting our target and not having this risk of volatile stocks. So these funds are out there. I gave examples of healthcare, and just quickly on healthcare, you look at the developed world, even China, all these countries are aging. There's a reason why more GDP every year is spent on healthcare. It's demographics. And so the healthcare fund that Vanguard has actively managed by Wellington has consistently over very long periods of time outperformed the S&P 500 and doesn't have the same drawdown. Same thing with the Vanguard Dividend Fund, different strategy. It's large cap companies that are very profitable, and the way they measure it is, do they have a history of increasing dividends over 10 years? These aren't the companies that are issuing the biggest dividends. They're just looking this is really a screen for profitability of companies. So they've selected in this fund typically about 40 of the most profitable big cap companies that are sold at a reasonable price in the fund or on the market, and they've added that to that Vanguard Dividend Yield Fund, the growth fund that I talked about. So, and that, because of that, it doesn't drop down as much as the S&P 500. That particular fund doesn't outperform the S&P 500 on the upside over time, but it comes very close to the S&P 500 over time without the significant drawdowns. So you put it all together, the Fidelity Fund, the Healthcare Fund, the Dividend Growth Fund by Vanguard, and history shows that it outperformed the S&P 500 without the drawdowns. So I'm not saying it has to be those three funds, but I really would like, an earlier version of my memo was asking the board a more complicated question, which was to ask Callan to give us an analysis of that alternate portfolio or anything else that they want to come up with. But I want us to look at not just what we've been doing. Here's an alternative way to look at our portfolio. Callan, do you have any other new ideas or different ideas? And let's compare notes and see what's going to get us the best deal. But basically, I'm really concerned that if we, I don't think the members, I don't think the plan sponsors, I don't think the community can put more money per member into this plan. I think we've elevated those contributions as high as we can all go. Everybody is suffering because of our elevated contributions to the plan, and ultimately, I don't think we have the luxury of reducing our expected returns to 6.9%. I think I would like us to keep our equity allocation as we've had it, keep that target of 7%, and I think we have a high probability of increasing our likelihood of hitting that 7% with a different mix of our equities.
Thank you, Trustee Jurdy. And before we have any further discussion on this, I would like to pass it over to Mr. Burke to explain the potential process that would have to be followed for us to reconsider anything that has already occurred.
Thank you. So just to provide the context, at last month's meeting, the board voted 4-3 with one abstention to proceed in a certain direction with regard to your asset allocation. And what Trustee Jurdy is asking for today, he is making a request for a motion to reconsider that decision. And so this board follows Robert's rules, but it also has a fiduciary duty with regard to the fund. And so there's some procedural questions in terms of who can make this motion. We're talking about a procedural step right now, this motion to reconsider what was done. And so in terms of who can make this motion, if you were one of the trustees who voted in the 4 to approve that asset allocation, or I believe the trustee who abstained, which is Trustee Cubison. So Trustees Harris or Cavanis are here today who voted in the 4 last month. They could make this motion, as I believe Trustee Cubison could also. If one of those 3 makes that motion, any trustee can second the motion, and then if it passes with a majority vote, then you've agreed to reconsider it procedurally. Substantively, and I think what Trustee Jurdy is perhaps getting to is that it would be agendized at a later date to come back when Callan is here and you could have a full discussion on it. So if there aren't any questions, I think the issue would be, does one of those three trustees want to make a motion to reconsider?
Thank you. Trustee Cubison.
I move to reconsider the adoption of the investment asset allocation made at the February 15th, 2023 Board of Retirement meeting.
We have a motion and a second. Trustee Cabinets, did you have other conversation? Okay. Are there any other trustees that would like to discuss the motion and second that are on the floor right now? Go ahead.
My thinking as this whole thing has evolved is that we need a calendar put together for us, pros and cons, but it's a little interesting to see, you know, to have as a guest at this time, a company that, if we look at it, would challenge most of us to say that this has been a great choice. My concern I voiced to Robert. I asked his thinking on this. I would like, if you don't mind, Robert, for you to give just a little synopsis on what you said to me yesterday.
So I just want to keep in mind that we're not getting into the substance. This is just a question right now, and I don't want to stop the discussion, but right now, this is just a procedural question, and there's a motion and a second to reconsider it, and then if you do vote for that, then we'll be coming back, just to be clear, on another day to get into the substance.
I realize that does come later, so if that's the case, I will retract my question, Robert, but I think there's a lot of thinking that we all need to do, and to have at least one good agenda item so we can, even though we're going to come back later, but so we can get down into the nitty-gritty of what this involves. So I support the motion, and I thank you, Dan, for the work that you've put in on this. It was a little embarrassing for our guests, but I didn't hear a lot that would help rebut what you were saying. So, yeah, I intend to support the motion.
Thank you, Trustee Harris. Trustee Anderson.
Thank you, and I just wanted to give a brief comment as to why I'll support the motion as well. I wasn't able to attend the last meeting, but I was able to go back and watch it all. And I know we've had a lot of discussions about liquidity and cash requirements and so forth that are going to be needed. And I think the primary, from Callan's perspective, the primary security that we had in meeting our cash obligations going forward were contributions. And given that we, in our rebalancing, in order to keep our asset allocation in line, there's a tremendous amount of liquidity over time that's come out of equities and into fixed income, as we've seen in this current month. And that I have some questions about that, certainly to Callan, that I'd like to pose to them. So I would be supporting the reconsideration.
Thank you, Trustee Anderson. Any other trustees would like to comment on the motion and second on the floor? About public comment regarding this item?
There is no public comment at this time.
Thank you, Ms. Zeller. Will you proceed with a roll call vote, please?
Ms. Harris?
Aye.
Mr. Anderson?
Aye.
Ms. Cubison?
Aye.
Mr. Dirty?
Aye.
Mr. Cromer?
Aye.
And Ms. Kavanagh?
Aye.
Motion's approved.
Thank you to Trustee Jurdy and all involved in that discussion. I don't believe there's any further action, Executive Director Runchler, on that specific item, just for future agendized.
That's correct. We'll agendize this item to bring it back at a meeting when Callan is there and can provide additional substantive support to the request from Jurdy for an evaluation of different portfolios and options for the board.
Thank you very much. That would take us to item number 5, discussion and possible action regarding board committees. I'll pass it over to Executive Director Rentschler regarding her memo prepared for that.
Thank you, Chair Cromer. Back in December, we did not actually review the board committee assignments, and we just wanted to confirm if there would be any change to the committees. The current committees are listed in the board memo with their members. Additionally, at last month's meeting, we talked about the potential for an IT steering committee to handle some of the decisions regarding IT projects stemming from the IT master plan. My question is whether the board strategic plan project committee would be handling the IT steering committee duties, or if there is a different committee to be established or a different trustee assigned to that.
Thank you, Executive Director. It's my understanding that the committee assignments are usually done by the chair, but with the cooperation and usually request of the members that are on them. Thankfully, everybody that's on the 3 existing committees is in attendance today. I would like to entertain any conversation from any of the trustees if they would like to be removed from any of the ad hoc committees, or any other consideration regarding Executive Director's comment that the IT portion could be covered under the Strategic Plan Board Project Committee, or we could form a new one.
Should we just go through the committees as listed, the first one being the audit committee?
Certainly. Let's address the audit committee. We have trustees Anderson, Cabaniss, Jurdy, and Harris, who are all in attendance.
I never wanted to be on the audit committee. So.
I will admit that I believe I was on the audit committee and never got invited to a meeting for a period of time, so, but I'm not asking to be on it.
Historically, the audit committee only met once a year. Starting last year, we did move to 2 meetings a year. There's a kickoff meeting right before our audit starts, and then we have the meeting after completion of the audit where the firm presents their results. So there would be 2 meetings associated with the audit committee work.
Thank you.
So I'd be happy to remain on the audit committee. Is that what you're looking for?
Well, I don't need every single person to say that. I appreciate it, though, but if there's only one person in attendance besides myself that's not on these committees, I'm not trying to put her on the spot, but it doesn't sound like Trustee Harris. Are you not wanting to be on the committee, or are you just saying that you never wanted to be and you're fine serving continued? So
I never wanted to be. However, our previous chair said that at some point everyone should serve on the audit committee, so she put me on it. So out of deference to our former chair, Smith, I will stay on audits. But I'd love not to be on strategic plan proposal review ad hoc.
we'll get there in a minute, but I don't know that there's much more work to be done under the
Okay,
plan.
so at
Well,
this point,
yeah.
it sounds like the audit committee would remain unchanged?
I would just ask Trustee Covison if she would like to be on this and replace Trustee Harris. If she doesn't, then I fully respect her wishes and would not appoint her to it. Unfortunately, not at this time. Okay, thank you. So the audit committee will remain as is assigned currently. Let's move on to the next one, which is the Strategic Plan Proposal Review Ad Hoc Committee. And I'm sorry, Mr. Anderson, I know you're the chair of the audit committee. I'm assuming since you didn't raise your voice or hand that you're okay continuing on that?
Yes, I'm
Okay.
fine continuing with that. And on the strategic plan committee, I think it's fulfilled its mission.
As far as the ad hoc, the proposal one?
Yes.
So would it be appropriate to dissolve that committee or have it remain even though they don't have any anticipated future meetings?
There will be, at some point, other RFPs that are issued for services that are in support of the strategic plan, which of course it was a 5-year strategic plan. We could either leave it and use it as necessary should we issue an RFP and need to evaluate proposals. It could be dissolved, but we would likely then need to set a new committee when we move to a point of soliciting bids for future services.
Okay. I know trustee Harris does not want to be on the proposal review ad hoc for strategic plan. Is there anyone in attendance today? I don't want to assign people that aren't in attendance, but I can. I know trustee Harris doesn't want to be, but I don't foresee any.
I'll stay on it, especially if it doesn't meet. That sounds like a good plan, but I was just trying to be helpful, I think, when I said I would serve on it.
Okay. And trustee Anderson, are you fine remaining on it if we keep it there with the anticipation that it won't be needed until it is?
Yes.
Thank you. That takes us to the Strategic Plan Board Projects Ad Hoc Committee. And that's a lot to say, but can I get some conversation or thoughts from the trustees as to whether we think the IT projects would be covered under that umbrella, or if we should set up another one?
I have no objection to the IT projects being under the Board Project Ad Hoc Committee. That committee has not actually done any activities, but there are certain goals and objectives in the adopted strategic plan that would require some board input, and that's why the committee was formed, but it has never met.
So go ahead, trustee Cavanis.
I would appreciate having the IT scope be supported with someone who has specific IT knowledge, which I don't have. So I don't know if we could either create another group, another committee, or if we could recruit someone into this committee who has, who's an expert on IT.
I would be looking, as far as the IT-related matters, to have some board representation in helping to set priorities, not necessarily needing significant IT knowledge. We will be engaging with a consultant or with our vendor, Levy, Ray and Shoop, who is our pension system administration firm, for their assistance on certain technical aspects of the IT plan. So I view the trustees' interaction to be really more in developing the prioritization of certain IT projects that might come forth.
Thank you. Trustee Jurdy, did you have a comment?
So it sounds to me what you're probably looking for from the board members are input, feedback from us about does one particular investment in IT result in something that we think is of value to the members or to the organization. So, there's probably an unlimited amount of money we could spend on IT, and so you're probably looking for some input about, okay, within the budget we have, what's the highest priority that we think for the members and for the organization?
Right. Some of the recommendations in the IT master plan were, let's say, a little bit vague, but we'll be working with LRS or our consultant to define some of those. But there are areas of opportunity, whether it's, they suggested moving towards straight through retirement processing, which meant really no staff involvement until the very end. The member did it all themselves online. I don't think we're necessarily going to reach for that, but that is one of the items that they mentioned in their discussions with me and in their IT plan. So it's looking at some of those suggestions and recommendations and saying, this one is of a higher priority to us and is helping us establish budgets for those items in consultation with our IT consultant to bring those projects forward. It's really, I view it as more prioritization of those objectives, yes.
So as long as you're not looking for a computer programmer, I think we can serve on that.
I agree.
Very good. So that committee is trustees Jurdy, Cavanis, and Executive Director Rentschler, and I'm inclined to keep that in status and in place with the understanding that the IT projects would be covered under that. So.
Great, thank you very much. I appreciate Catherine and Dan's participation in that committee.
Thank you. I don't believe there's anything else under item 5. Is there any public comment, even though we've pretty much made our decisions?
There is no public comment.
Thank you. Takes us to item number 6, discussion and possible action regarding a board meeting remote attendance policy for trustees. Pass it over to Executive Director Rentschler again.
Thank you, Chair Cromer. There is a draft policy provided in your packets. There had been previous discussion at meetings that potentially we may want to have a remote location on the coast to facilitate remote attendance under the Brown Act rules. The location would need to be open to the public for public comment, et cetera. And this policy would be essentially some guidelines in support of us moving towards some sort of remote attendance. The second portion of the policy also addressed the guidelines for the emergency exception provisions under the Brown Act and utilizing those provisions. So if you have any questions regarding the policy, I'm happy to answer any questions or put our attorney on the spot in case you have questions regarding the Brown Act provision specifically. Although we have not done any remote attendance meetings, since there had been discussion, we were just trying to get out ahead of it and sort of lay out some guidelines for that. It's at the board's discretion whether or not you wish to adopt a policy at this time.
Thank you, Executive Director. I personally agree with that. If we think it might be a possibility in the future, we might as well have it approved and ready if and when needed. Is there any other conversation from trustees regarding this item? Go ahead.
There were times when the weather was really bad over here, and I would go to the local school district because they were already set up and all we'd do is put a piece of paper, and I would meet in there, and it was, not a problem for anyone. So I think that would be a help with our coast folks. Getting over here over the last few weeks has really been a problem for them, and I think anything we can do to facilitate their not having to drive Highway 20 in a storm or any one of a number of other inconveniences. So,
Thank you, Trustee Harris. Any other conversation from trustees or comments, ideas?
Be happy to make a motion to approve the recommended policy.
Thank you. You're batting 1,000 today.
Second.
Thank you. Any other trustee conversations regarding the proposed motion and second? Ms. Zeller, is there any public comment regarding this item?
There is no public comment.
Thank you, Ms. Zeller. If you'll take a roll call vote, please.
Ms. Harris?
sorry, aye.
Mr. Anderson?
Aye.
Ms. Cubison?
Aye.
Mr. Jurdy?
Aye.
Mr. Cromer?
Aye.
And Ms. Cavanis?
Aye.
Approved.
Thank you. That takes us to item number 7 on our agenda, discussion and possible action regarding the boardroom audio-visual equipment upgrade. Executive Director Rentschler.
Thank you, Chair Cromer. At one of the previous meetings, we were directed to look into the cost to upgrade the existing conference room at the MSARA headquarters that has traditionally been used for our board meetings. The county IT staff provided 3 different options for upgrading the equipment within the room. It attempts to utilize much of the equipment that we already have in that we wouldn't be replacing the white screen and projector. We would still be using that. We wouldn't be replacing it with like a large video monitor. The options basically all include getting a new mixer, which they often refer to as the streaming box. That would allow us to continue to do hybrid meetings from our own facility. That piece runs around $5,000 in its own. The rest of the costs would be either new cameras and/or cameras and microphones, depending on the option the board may wish to pursue, if any.
Thank you, Executive Director. Is there any conversation from trustees regarding the 3 proposed options or whether you have any intention to pursue any of those options? Trustee Anderson.
Yes, I appreciate Trustee Jurdy's recommendation for use of this facility, but I view it as something that's really a short-term fix, and I'd like to see the MCERA offices be prepared to hold their meetings there. And if we're going to do that and looking at the options, my recommendation would be that we do it correctly and completely. And so I would be supportive and would be happy to make a motion for option one.
Is that an option at this time, or you would be happy to if needed?
I will make a motion for option one.
Thank you. We have a motion on the floor. Is there a second or further conversation regarding the motion for option one?
May I just mention that with option one, you would all have individual microphones similar to the setup here that would require that they actually drill into the conference table to mount those microphones.
Thank you. I will personally bring up that I'm somewhat torn on this item, and the reason for that is this room we're never going to compare to in the Retirement Association's boardroom, and I don't think that we are, but if it's available, I think it is a better option for the community, knowing that they come here for other meetings and it is a centralized location, but our room is just smaller. So that's where I'm torn in the sense of saying I don't think we have other rooms in that building because it's a very limited space, but there's nothing we can do to provide more room in that setting. It would just be to increase the technology. But I also see the fact that if this room here is not available, we have to have a backup alternative. And I've heard the same disgust and complaints that people can't hear us at our meetings, and that's not acceptable to me either. So. I will accept a second, and thank you. Okay, so we have a motion and a second. Is there any other further discussion from trustees regarding the item on the floor? Trustee Covison?
My concern was the space issue, and so I'm just wondering if we want to consider option two, perhaps if we're not looking at permanent location for ongoing meetings, if that's really just going to be the backup option. And I don't know if those are just sitting on the table, not mounted in the table.
I believe option two also mounts them to the table, but it would have maybe only 2 or 4 on the table. So it wouldn't require 12 seated locations. And if we do have trustees who are choosing to attend remotely, then we may not have the full complement of 10 trustees in our conference room. So maybe we don't need 12 microphones, you know. So that is kind of perhaps a middle ground where we would have 2 to 4 that are placed out on the table to provide a better audio than we currently have. The reason we cannot currently use the ceiling-mounted microphones is that we cannot utilize those with our existing streaming box with a hybrid meeting. Well, we don't have a streaming box, we have a mixing box, but we need to upgrade that box in order to do a hybrid meeting because the board has specified that they would like to continue to provide a streaming remote access for the public to be able to more easily attend and hear our meetings. And so the biggest cost would be getting that upgrade. If we upgrade the box, we could return to using the 2 speakers, or not, speakers, but microphones that are mounted on the ceiling. And I am told by the IT person that they would provide adequate, similar to the performance we had before. If we return to using those, they would suggest upgrading the cameras.
Trustee Anderson?
Just one comment and then a question to staff as well. This morning isn't the best test in that we're down on trustees. And as I look around, I wonder what the configuration would be if we had a full board attendance at a meeting here. But secondly, I'm very curious, I guess, from a staff standpoint, your perspective on coming over to this office versus conducting a meeting at the MCERA facility.
I would say it's not significantly difficult. We brought the nameplates and some bottled water, and that was most of it. We had come over to learn the equipment, came in a few minutes early to get familiarized with items and get the screens up and running. As far as your question regarding if we had a full complement of 10 board members here, These 2 seats or 3 seats would be filled with trustees. We would utilize the position here in the center that's not currently being occupied, and some staff, or council, and all of our vendors who may come in, like money managers or anything, Callan, would be seated there and speak at the dais in the public seating area.
I just wanted to mention that there are a number of boards like this board in Mendocino County. So, for example, there's Local Agency Formation Commission, there's the Mendocino Council of Governments, and they don't have their own conference room or their own building, and so they meet in places like the Board of Supervisors chambers, or in years past, say at the Ukiah City Hall. So I don't think it's out of the ordinary to have an important county board to meet in this room, at times when the Board of Supervisors are not meeting.
Thank you. And I'll say my concern with the other 2 options is this: there's a price savings for option 2, obviously, of over $6,000, but option 2 to option 3 is not a huge price savings. And my concern is, if we're going to approve one, let's make sure it works. But also, if we were to eventually not go with option 1 and consider option 2 or 3, spending that money and not having an improved audiovisual capability. So again, I'm still torn, but if we need to have at least a backup to make sure it's functional, for whatever reason we have a conflict with this room, I believe I'm personally in support of at least making ourselves self-sufficient. But
We could use the existing cameras, and that would put the cost at roughly just the new streaming box, around $5,000. IT says if you're going to go to the effort of replacing the streaming box, our cameras are fairly old, and they would recommend upgrading the cameras, but they certainly function. We've used them recently, I think. So it would really just be at the board's discretion how much they wish to allocate towards this project of upgrading the conference room at MSARA.
I think that's the issue with technology. The second you buy it, it's probably already outdated. But go ahead, Trustee Covison.
I guess my question is, I know this is discussion on the audio-video capabilities of that location, but I don't know if we need to have a more robust discussion on where we really want to meet on an ongoing, regular basis, if whether this is the location we prefer to do moving forward, and what the cost and logistics are, or whether we actually think we're going to return on a regular basis, because it does seem to me that that conference room is going to be kind of small on an ongoing and regular basis if we want to continue to stream and provide that audio capability. So I just want to know if everybody feels like we make that decision for either one of these more expensive options, are we still coming here, or are we going back there? I mean, I don't have a problem being capable. I think it's a good idea to have a backup plan, but I'd also wonder, what is our ongoing intent?
So I would like to give you an update regarding the use of this facility. I had previously said that the rental rate would be $75 an hour with a 2-hour minimum. And the policy was recently changed, and it's now $75 for a half-day meeting or $150 for a full-day meeting. That makes it a little bit easier to know what our costs would be going in, because we don't always know how long our meetings are going to run, but we could certainly know that we'll expect it to be only a half-day meeting or less, or that we would expect it to run long and need it for potentially a whole day. So the cost is less than initially provided in my previous memos to utilize this facility. Now, of course, there are other groups that use this, and it is sort of on a first-come, first-served basis, and if the Board of Supervisors wants it, they always will have preference over anybody else who has booked it. And that's why it would be prudent to have a backup location. We can certainly look at other conference rooms, but there have been limitations in some of the other facilities that are set up for audiovisual meetings. I think it's a nice compliment to have MSARA's office available if we choose to no longer meet here, or we need it as a backup because this facility is already booked.
And along the same lines, we have reserved this room for the next future meetings through at least 3 in a row, right?
I reserved it through June.
Thank you. Any further discussion or comment regarding the proposed motion and second on the floor? Trustee Harris.
I believe there was a question as well. This is just addressing IT, but if we were going to continue to use the conference room at MCERA, about the window and putting in a window, is that something that is discussed now, or?
Thank you for bringing that up. I had not brought back information on that because although we have requested an estimate to replace window in the conference room with operational windows that would open, the maintenance firm came out and took measurements, but I have not received the actual quote for the job yet. I will bring that back as more information is available.
Thank you.
So just to Director Cubson's comment, so my feedback is I would prefer to meet in this location and not there. I mean, if that, worst case scenario, if we need to meet there as a backup, fine. I don't know if that's the feedback you were looking for from one board member anyway.
I feel similarly that this is probably option one, but I also, I get that $16,000 is a lot of money, but we need to have a backup plan, and I want to continue to encourage public engagement in our meetings and participation. So I know we're going to get there in a minute, but I am supporting the motion just to make sure that we have a backup if all else fails. So, is there any other conversation from trustees? How about public comment regarding the item? Sorry, before we go to that, Trustee Anderson.
Yeah, just one more. It's nice to see Robert in person for the first time in a while. And I guess I would flip Shamice's question around as to, does staff have a preference? Is this a better working solution for a meeting for you and more comfortable with the social distancing and so forth than, say, trying to create a better situation at the MCERA conference room?
Judy and Robert, do you have any comments on that?
I think the use of this meeting space has worked out fine in my opinion. I do want to mention that the ad hoc committees also need a space to meet. The audit committee will also need a space to meet. And if we're going to continue to use this space, we'll have to book those meetings in advance. So just to keep that in mind.
Those ad hoc and audit committees could meet at our office, though.
True.
I'll take the less popular view. I'd like to see us meet back at MCERA.
Understood.
I have no strong preference. I was just pleased I remembered to drive here this morning instead of over to MCERA.
Yes, thanks for all remembering to show up here and be present here.
And early.
I think staff's done a great job under Doris's umbrella of trying to promote the retirement system and trying to make us more individual from the county. And I do see coming and meeting in this space, making us, more tied to the county and less independent as far as our meetings go.
Thank you. Now let's try for public comment.
There is no public comment.
Thank you. We have a motion and a second. If you could take a roll call vote, please, Ms. Zeller.
Ms. Harris? Aye. Mr. Anderson?
Aye.
Ms. Cubison?
Aye.
Mr. Jurdy?
Aye.
Mr. Cromer?
Aye.
Ms. Cavanis?
Aye.
Approved.
Thank you. Handles item number 7. Next up is item number 8, discussion regarding the administrative report. And I'll pass it again to Executive Director Rentschler.
Thank you again, Trustee Cromer, or Chair Cromer. I wanted to update the board on our upgrade to Member Direct, our self-serve portal for the pension system for our members. The rollout should be occurring in April, and that will refresh the user interface and add two-factor authentication. Robert attended the Calipers General Assembly on my behalf since I had a conflict with the date we selected for the pre-retirement webinar. We have had the roofer out and are waiting for the figure to repair the roof. We currently have now 2 leaks. Yesterday, our tenant reported a leak in their space, but when they came out and looked at the roof to give us an estimate, we only knew about the one spot that was leaking, so we'll try to get an update on that and come back to you. Our area is tarped. There's been no further water penetration into Suite B, where Sarah is. We do need to get a tarped for Suite A, so there's no further water penetration at that. I believe PCS indicated they would send someone out. Judy could confirm that. So we also had a water leak. We had 2 breaks in our irrigation system that have since been repaired, and a leaking toilet over in Suite A, which also has since been repaired. That probably ran about $1,200, I believe, between fixing the 3 leaks. I did note here that we did receive a response, only one response, to the request for qualifications for architectural services. Robert, I, and Trustee Shoemaker have actually spoken with the firm. I'll bring back more information to the board on that separately. Reminder, Form 700 are due by April 1st. Please send your form to Judy if you file directly, and you can provide Judy with a copy for our records. We'd greatly appreciate it. We had a good response to the pre-retirement seminar. I provided some comments on that on the second page. I think it went well, and we specifically asked folks what would they do different from the information they obtained by attending at the seminar, and I found those comments very enlightening. There's also some legislative items from SACRS provided for your review. I'm happy to answer any questions you may have.
I just really appreciate seeing the comments of the people who attended. Kind of gives you an idea of what they're thinking about and what they learned at the workshop.
I second that as well, and my only other comment regarding your report is the 2-factor authentication. I know that I work with a certain group of people that are not savvy in such technology, and I've assisted some of them, so I anticipate a need from the Retirement Association staff to assist some of our members with that process while ensuring them that it's for their own protection, because we've had some threats.
We do have some materials drafted to roll out the fact that 2-factor authentication is coming, along with visual guides to assist them, and staff will be available to help answer those questions over the phone and walk them through that process.
Thank you, Trustee Anderson.
Just to echo Trustee Jurdy's comments, I appreciate the comments. I think they're solid comments, and I wanted to thank staff again for the newsletter that just went out. You know, the commitment that we talked about during the strategic planning process to have our members really feel like human beings, that we really care about them and their future and the security of their retirement and so forth. It really comes through in the way you're crafting it and the information that you're sharing, and I just really appreciate all the work.
On topic of the newsletter, I would like to thank Trustee Jurdy, who has provided us with 2 book reviews. Staff also has drafted 2, and we'll be running basically a book review on financial planning or investments quarterly in the newsletter.
Thank you. Trustee Harris?
The members of SACRS and other public entities have any kind of policies that could be used to fight bills like this? The whole fossil fuel, cigarettes, the very student actions, whatever, that require or are trying to require divestment, put, in my opinion, put plans in real jeopardy. And I think if we tend to look at things like this bill and say, well, it really doesn't apply to us, and then all of a sudden we get one that it applies to 37 Act retirement plans, puts a huge, almost a target, I believe, on these portfolios. It's become the thing to do if, you know, if you want to change things in California. So I'd just be real interested in whether there is any reaction to this bill, or if we could.
If it did move forward out of committee, certainly the retirement system could take a position on it and submit a letter to the sponsor in support or in opposition to the proposed legislation. Our association has done that in the past with other pieces of potential legislation, and I would say that feedback from the systems with that other bill were successful in getting it significantly modified. You are correct that these types of mandates almost take away some of the board's ability to fulfill their fiduciary duty, which is to maximize return on assets in the plan while minimizing cost. And certainly there would be opportunity to object if it moved forward.
Thank you.
Just my thought is, I mean, I feel like if we could have our cake and eat it too, it would be to have our collectively our advisors, you know, voting on these boards to be pushing those companies to change their way of doing business, rather than disinvesting from them. And an example of that is Shell, for example, purchased one of the largest electric vehicle charging companies in California or United States that's installing electric vehicle chargers. You know, so that's a petroleum company moving into the electric space. Snow and Clean Power, which is 94% carbon-free power for our customers. We just partnered with 3 companies to develop more advanced versions of geothermal, which is 24/7, 365-year, you know, basically carbon-free power. And 2 of those, one of those companies is Chevron. It's a branch of Chevron that's in this, and another one is leaning on Chevron to help them. Because the geologists who work for the oil companies have the expertise that you want for something like geothermal that isn't readily available, you know, in the open market. So it's just my 2 cents. You know, if we could be pushing these companies to move into a different realm, and I think there's some indication that some of them are, I think that would be more fruitful than just saying, oh, we're going to totally disinvest.
Are bad ideas. They're very good ideas. But usurping our fiduciary duty to protect our portfolio for our retirees, it just seems like it snowballs once ideas like this get started. And they cost our retirees money and our future retirees money, and I think we need to be aware of them.
Thank you, Trustee Harris. Any other board member, trustee discussion regarding the administrative report? Any public comment at this time on that item?
There is no public comment.
Thank you. That takes us to item number 9, general board member discussion. Do any of the trustees have matters or items they would like to discuss as general board member discussion?
I'd like to thank Dan again. Really, really very good. I think that's what board members are supposed to be doing.
Thank you, Trustee Harris. I will bring up that I will be working with the executive director before the next meeting regarding the secretary position, which is now vacant. So we'll try to have that agendized for the next meeting. Mr. Hawkins?
Oh, yeah.
Yeah, he was our secretary.
Yes, we
Yeah.
can agendize
Yeah. 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 I just wanted to bring it up that it wasn't lost on me that he was our secretary, so we'll have to take action on that, but I don't think it's urgent at this time, so we will do that. Any other trustees? Yes, Mr. Anderson.
Well, you mentioned that, I was curious if we have an additional vacancy. Is there any movement at the Board of Supervisors level on filling that?
We do have an appointed position which is vacant. We have not, to my knowledge, had any people express interest past one a few months ago that Trustee Smith brought to our attention, who person was deemed ineligible because of relationship to the county, because this person has to have essentially no relationship to county activities. If you know anybody, I would strongly recommend that you harass everyone you know into applying to serve on the board.
I have spoken to some people in the Fort Bragg area, but it's a bit of a stretch, for them to be on this board. So, yeah, I think we're probably more likely to get someone who lives in the
Did
Ukiah
you
Metro.
offer to carpool?
Yeah, there.
All right, well, I appreciate that update, and yeah, position's been vacant for a while, but anyone that's watching this, we implore you as well. If you're a member of our association, and it's all of our association, please, if somebody has an interest, then encourage them to apply. So, hearing no other comments, that moves us to notice of the next retirement board meeting, which will be April 19th, 2023 at 8:30 a.m. here at the Board of Supervisors chambers, and we are moved to adjourn. Thank you.
Thank you.